A renewed sense of anticipation is sweeping through the Pi network community after receiving a notable nod from the venture capital world. On July 9th, discussions around the project reached a fever pitch, not only because of its future potential, but also due to growing concerns about the network's tokenomics. This heightened attention came in the wake of 137 Ventures, a respected VC firm known for its early backing of tech powerhouses, identifying Pi Network as one of the crypto projects worthy of serious institutional interest. Since then, the network has become a focal point of intense speculation, fresh analyses, and increasingly urgent calls for policy changes. The endorsement from 137 Ventures has been seen by many in the crypto space as a game-changing moment for Pi Network. As one of the more unconventional blockchain projects, Pi has always stood apart in both vision and execution. It's a mobile-first initiative that's built a user base from the ground up without initially focusing on open trading or exchange listings. This grassroots-driven approach, while unconventional, has led to a community that claims over 50 million active participants globally. For years, supporters have pointed to this model as a revolutionary strategy, delaying public mainnet trading in order to establish a robust ecosystem first. Now, with 137 Ventures recognition, many feel the validation they've long awaited has finally arrived. But along with this validation has come a wave of scrutiny. Supporters and skeptics alike have taken to various platforms to debate what this means for Pi's future. One of the loudest and most divisive points of discussion centers around the token's inflationary structure. Critics argue that without a clear limit to supply or mechanisms to curb ongoing issuance, the project could risk eroding its own value over time. A prominent technical analyst going by the name Cryptolite_247 voiced this exact concern in a widely shared post on July 9th. He stated, "As long as #PI does not get a burning mechanism, the price may bleed slowly." His commentary tapped into a simmering concern among longtime followers of the project. The post triggered a flood of replies, ranging from support for deflationary tactics to passionate defenses of Pi's current distribution model. The divide within the community has grown more pronounced. On one side are advocates for implementing a token burn mechanism, believing that reducing supply over time is essential to preserving value and investor confidence. On the other side are those who maintain that early-stage inflation is a necessary feature, not a flaw. They argue that wide token distribution ensures fairness and gives more people the opportunity to engage with the network during its foundational years. Still, both camps share a common desire. They want clarity and transparency from the Pi core team. As the network approaches the most pivotal moment in its history, the anticipated launch of its fully open mainnet, the pressure on the developers is mounting. Until now, trading of the PI token has remained restricted within a controlled, internal environment, effectively isolating it from the broader crypto market. This has allowed the core team to cultivate its ecosystem slowly, without exposing the token to the wild swings of open exchanges. However, with the Open Mainnet expected to launch soon, users will finally be able to trade their PI tokens freely outside of the walled garden. This transition could either serve as the crowning achievement of Pi's careful planning or expose unresolved flaws that may erode user trust. Everything depends on how the team manages the coming rollout, especially in terms of token utility, real-world use cases, and liquidity. In terms of market action, PI is currently trading around $0.46, sitting within what traders commonly refer to as an accumulation zone. Market analyst at Lillian Obodo commented that the 40 cents to 50 cents price range has historically acted as a launchpad for bullish moves. In a detailed post on July 9th, he observed that the PI price chart appears to be closing out its accumulation phase, hinting at a possible breakout toward the $1 level. If such momentum does materialize, it could usher in a new wave of retail enthusiasm just as institutional curiosity begins to bloom. Of course, such price movement isn't guaranteed, and investors are well aware of the many variables at play. One of the most pressing is whether the Pi core team will consider structural changes to the token's economics. The attention from 137 Ventures is a double-edged sword. It not only brings prestige but also significantly raises expectations. As more institutional players begin to investigate the project, there will be demands for stronger governance, clearer financial models, and a roadmap that supports sustainable growth. Some community members are already floating suggestions aimed at refining the token model. These include ideas like implementing periodic token burns, introducing staking mechanisms with lockup periods, or even placing hard caps on future supply expansion. While nothing has been confirmed by the team, the fact that these conversations are happening in public spaces shows a maturing ecosystem that is ready to take the next step. There's also the matter of external perception. Institutional investors are known to be wary of crypto projects with vague or unchecked monetary policies. If Pi Network wants to be taken seriously at this next level, it may need to adopt more traditional economic safeguards to satisfy this new audience. The challenge will be finding a way to do so without alienating the early adopters who have championed the project from its inception. Over the coming weeks, Pi Network faces a critical juncture. The enthusiasm sparked by 137 ventures has reinvigorated the community and put a global spotlight on the project. But that attention comes with heightened scrutiny. The next 30 days may well determine whether Pi is able to fulfill its ambitious vision or falters under the weight of its internal contradictions. The core team's choices, especially concerning tokenomics, communication, and the Open Mainnet, will be closely watched. If Pi can manage to balance its original values of decentralization and accessibility with more sophisticated financial tools, it could redefine how blockchain adoption unfolds at scale. If not, it risks becoming another cautionary tale in a crowded and competitive space. What happens next will not only shape Pi Network's trajectory but may also influence how the broader crypto world views mobile-first, community-driven projects in the years to come.